to avoid the next Silicon Valley Bank debacle. Debacle. That's such a great word. Debacle. The U.S. should adopt Australian taxation rules. What? Josh, are you crazy? Hear me out for just a second. So I'm reading my morning reading. So I start the day with a good book. I'm in Jeremiah now. Actually, very interesting Jeremiah. Jeremiah 8:8. I invite you to read that. Jeremiah 8:8. Stop everything you're doing now. Pick up your good book and read Jeremiah 8:8. It's actually funny because so then I start that and I read the good book. And I open my other book. So I'm reading. I always have something to read in the morning. I got 8 million, thousand, billion, trillion books sitting here. I'll never read them all, but just stressful seeing them say, oh, I got to read these books. But anyway, so I'm reading this one. Again, I read this before, 10 years ago. The Misbehavior of Markets by Benoit Mandelbrot. And we come to this chapter or section right here. Page 167. Economics is a science of fashion. Keynes and pump priming at one time, Friedman and monetarism at another. The profession burns through new theories like a teenager hops from one date to another. It's funny. Modern finance was the official religion when Benoit was breaking into the realm of academia. Modern finance was the official religion. My hypothesis contradicted it. This is so freaking funny. I was about as welcome in the established Church of Economics as a heretical Arian at the Council of Nicene. Oh my, dude. I think some of us are just cursed to be heretics. There's no other way around it, to be anti-orthodox. I hope you understand how great of a line this is. I was as welcome at the established Church of Economics as a heretical Arian, not an Aryan like a freaking Aryan Nation thing, an Arian, A-R-I-A-N, like an heretical Arian at the Council for Nicene. Man, if you don't know what that is, I'm not going to get into it here, but oh man. Anyway, so then I came across this. In 1972, a University of Chicago grad student, Robert R. Officer, crystallized many of the qualms of the economics establishment. His PhD thesis found evidence for and against strict scaling of the same set of data. All right, anyway, so I'm reading this. Okay, I'm like, well, whatever happened to Robert R. Officer? If Mandelbrot is talking about this guy, whatever happened to this guy? He just kind of said a University of Chicago grad student crystallized many of the qualms of the economics establishment. So I'm thinking, what's going on here? So I look up Robert R. Officer. I came across this, the Faculty of Business Economics, I think it's University of Melbourne. Now, I've never heard of Robert R. Officer. I know, I like to think I'm a economics student of the business, so to speak. So I was like, who's that guy? I never heard of him, but Mandelbrot's writing about him. I'm like, huh? All right, so anyway, we read a little bit about Robert R. Officer. Class of 1962. He returned to his alma mater in 2019, where he's awarded an honorary doctorate. Okay, so let's keep reading. Professor Officer has given us years of distinguished service to the Australian community through his rare and exemplary blend of theory and practical application to the benefit of many. I'm like, okay, whatever. Again, never heard from this guy. I'm like, is this the same guy? And then I'm reading down here. He graduated with a PhD from the University of Chicago in 1971. Exactly. Mandelbrot mentioned that right here. There's in 1972, a University of Chicago grad student. Exactly. So this is the same guy. Officer is at the forefront of applying economic principles to financial markets and decisions. On returning to Australia, he was one of an elite group who brought the systematic study of finance into the mainstream. So check this out. One of Professor Officer's most notable and lasting contributions has been the reform of Australia's taxation system. His rigorous analysis and advocacy of the imputation system of dividend taxation played an important role in its adoption in Australia in the late 1890s. Interesting. And this is what I was like, okay, so good. I'm digging this. I'm thinking Australia is kind of weird, but whatever. Let's keep going. This right here, though, has been a major reason why, unlike most comparable countries, Australia does not have a damaging inbuilt tax-based bias that encourages companies to borrow rather than raise new capital from shareholders. What? I'm telling you, it has been the major reason why, unlike most countries, Australia does not have a damaging, inbuilt tax-based bias that encourages companies to borrow rather than raise new capital from shareholders. Ooh, I was like, yes, yes. Taxation on dividends are double taxed, and that you can write off debt. So a company can say, we can pay more dividends, but we're going to pay the dividend from net income, which you have to pay tax on, and then the shareholder has to pay income tax on the dividends as well. It's called double taxation of dividends. And it can be QDI, it doesn't matter. You're still paying double taxation. Yet a business, on the other hand, can say, hey, I don't want double taxation on dividends. So what I'm going to do is I'm going to borrow, maybe to purchase back shares. That way they don't have to pay tax on the net income. And they still have to pay tax on net income, but they don't have to pay tax on the dividends. So what they can do is they get a little bit of a long-term capital gain boost by borrowing, because the debt that accumulated, the interest is taxed. You can write that off. So the taxation system we have in the United States encourages borrowing. It doesn't encourage dividends. So let's keep reading. So I had written an article about this probably 20 years ago in the Shenandoah Valley Business Journal. I'll never forget that. It said dividends are double taxed. Let's keep going. Well, why this taxation structure is risky here in just a second. But let's talk about how can Australia's dividend-friendly rules be implemented in the United States. Dividend seekers in the U.S. are experiencing lean times. All right, let's see. It's not like that everywhere in the world, though. Of the G20 countries, the U.S. ranks 15th in equity dividend yields. Australia tops the list with more than 5%. This is probably 2017 or 18, this article. Australia has a yield of more than 5%. What's Australia doing that the U.S. isn't? Is that something that can be replicated here? The answer in large part is dividend taxation policy. In the U.S., corporate dividends are double taxed. They are taxed at corporate level earnings from which the dividends are paid, and then they're taxed again to the individual. Ooh. This treatment significantly reduces the dividend ultimately ends up in the shareholders' pockets. In Australia, dividends are only taxed once. What happens is you get a franking credit. Is a tax credit that is given to shareholders who receive dividends on equities. Investors who receive corporate dividends get a corresponding franking credit that can be claimed on their tax return. So they're going to give us an example here. Let's assume a country in Australia wishes to distribute a dividend to its shareholders. We'll also assume that the company pays a standard Australian corporate tax rate of 30%. All right, if XYZ company earns $1 a share on a pre-tax basis, it will pay 30 cents in corporate taxes and distribute 70 cents. All right, so basically they're distributing all their net income, just for simplicity. No one really does this, but in this case, they have $1 of net income, they're distributing it, all of it. 30 cents go to Uncle Sam, whatever version of Australia version of Uncle Sam is, Uncle Karen, I guess, because all the friggin' lockdown insanity. And then 70 cents goes to the shareholder, all right, as a dividend. The shareholder will receive 70 cents as a dividend and a 30 cents franking credit to offset the corporate taxes already paid, essentially giving the shareholder a full $1 per share dividend. If the shareholder's marginal tax rate is 25%, the total dividend they'd end up receiving would be 75 cents. All right, again, so they get a 70 cents from the company, they get a 30-cent capital credit essentially. So they have $1 of income, all right? Now, if they're 25% marginal tax bracket, they still got to pay 25 cents in taxes, but they're netting 75 cents. All right, let's keep going. Using the same example in the U.S., $1 pre-tax profit would be taxed at the 35% corporate tax rate. And again, this got to be before the Trump tax bill. So a 65-cent dividend available to the shareholders. If the shareholder pays a 20% rate on dividend income, the final dividend is just 52 cents. So in this case, that $1 of dividends, when 75 cents ended up in the back pocket of the Australian shareholder, only 52 cents ended up in the back pocket of the American. Now, again, there's a couple different things here. Corporate tax rate is a little bit lower now, but still, you get it. I mean, that's a significant difference, dude. And that's like a 50%, that's more than a 50% increase, Australian dividends relative to Americans. All right, so let's check this out. And again, if we go back to Robert Officer, Australia does not have a damaging inbuilt tax-based bias that encourages companies to borrow rather than raise new capital from shareholders. You raise new capital by saying we have a high dividend rate. If you invest with us, you're going to get that high dividend rate. Or you can say we're going to borrow, which is a debt, which we can tax deduct. But borrowing does what? Speculative. So let's take a look here. I said, what was the bankruptcies? And here's the bankruptcies according to Trading Economics. In the month of February, there were 13,481 bankruptcies in the U.S., all right, in the month of February. That might be, I'm not sure what that reference, I'm not sure. But anyway, either way. The last data allowed for the last month was 13,481. Scroll all the way down here to Australia. There's only 238. Now, Australia has what, 25 million people. The United States has 330. So we take our trusty calculator. We say 330 divided by 25. U.S. is 13 times as large population-wise as Australia. All right, but now we go with 13,500 bankruptcies divided by Australia's 238, 56 times. So we had, what's that, 56 divided by 13. That's 4.5 times as many bankruptcies in the U.S. as Australia had relative to population size. Now, Australia, obviously, U.S. is a lot more entrepreneur. We're go-getters because we kick ass. Australia smokes grass, and U.S. kicks ass. You know what I'm saying? But we are motivated, individualistic, not like Australia, who's we got to pay attention to the Queen. We got to listen to what they tell us about the lockdowns. Look, I get it. Australia isn't nearly as dynamic as the United States because the United States kicks ass. Even with that said, that's a significant difference in bankruptcies. All right, now, I don't want to live in Australia. I don't have no desire to be in Australia. Australia has nothing to me. But check this out. So I said, what is the biggest corporate bankruptcy in Australia's history? And we got this one, HIH Insurance. Australia's second largest insurance company before it was placed in provisional liquidation in 2001. The demise of HIH is considered to be the largest corporate collapse in Australia's history, about $5.3 billion. All right. Investigations to the cause of the collapse led to the conviction and imprisonment of a handful of members, and they didn't really do that much time. But anyway, so let's go down here. What caused it? With $8 billion in assets, HIH was considered one of Australia's largest insurance firms. However, after offsetting its assets with debts and potential insurance claims, does that not sing true to Silicon Valley Bank? What is a deposit at Silicon Valley Bank? It's an asset to the depositor and a liability to the bank. It's literally the exact same thing. So they get $8 billion in assets. However, after offsetting its assets with debts and potential insurance claims, HIH was left on paper with a net asset of only $133 million. Their version of KPMG described HIH's solvency as marginal and stated in the report, this sounds like McGrath and Riddle is probably their version of the auditors, essentially. KPMG, I think, is who did Silicon Valley Bank. Who's the other guys? It used to be Arthur Anderson. I don't know who they are anymore. You know what I'm talking about. So their auditors stated in the report that an extremely small movement of just 1.7% in the value of the assets could move the balance sheet into net deficiency. That is, even the slightest setback would cause a company to become insolvent. And then on March 2001, the board of HIH appointed a provisional liquidator to take control of HIH. The board hoped this would give it time to review its operations and assess its financial position. On the same day, it was to announce its first half results on the same day. It was to announce its first half result for the first 6 months of December of 2020, the first 6 months of 2020. The announcement had already been delayed, and rumors suggested that HIH's first half loss was $100 million, which quickly blew into $200 million, and then to $300 million. Although the result was never announced, when Tony McGrath announced his appointment as provisional liquidator, he estimated that HIH had lost over $800 million over the 6 months previous. He contributed to failures to rapid expansion, unsupervised delegation, extensive and complex reassurance agreements, underpricing, reserve problems, false reports, reckless management, incompetence, fraud consulting. So let's take a look here. Here's Lehman Brothers. 2008, 691 billion of schmackes. Washington Mutual, WorldCom, GM, CIT, Enron, Conseco, MF Global. Remember MF Global? You remember him, John Corzine? Freaking clown. Why is he not in jail? Chrysler, Thornburg Mortgage. Look at 2008, 8, 2002, 9, 1, 2, 2, 2, Financial, whatever this is. American Savings and Loan, 1988. Refco, Banks, Global Crossing, Bank of New England, General Growth. Anyway, I remember freaking MF Global, by the way, like it was yesterday. Anyway, the point, I wonder how many of these had stadiums named, had corporate stadiums named after them. I bet a lot. And look at that dude. Billions. This is literally just 7 years after HIH went bankrupt, and it was $5 billion. This is $691 billion on top of that right there. That's over $1 trillion of assets pre-bankruptcy. Now, how does this stuff happen? Here's PG&E. Leverage, baby. It's all about leverage. Why do you think the banks are always doing it? Look, banks, and WorldCom's bank, Enron was Conseco, financial, residential mortgage, financial, brokerage, bank holding, bank, real estate, because it's heavy leverage. They're taking on leverage. How do you go bankruptcy? You can't pay your leverage back. It's just that simple. So we're encouraging bankruptcies left and right by taking on leverage. And when the leverage doesn't work for just a tiny fraction, your ass is grass, baby. You're SOL. And so we don't see huge bankruptcies in Australia the way we do here. Now, again, everyone's going to say, well, it's not different. I get it, man. 5.5 billion in 2001 versus a trillion in 2008 or whatever it was, 9. Yeah, that's not. You can say the population is sizably smaller. They're not as aggressive financially. At the end of the day, though, we are encouraging bankruptcies. And look at all those bankruptcies. And the whole reason is because Glass-Steagall. We got rid of Glass-Steagall, so we allow for speculative investments for banks, and they're leveraging to the hilt with depositors' money. You got to get rid of this dude. And that's the only way to avoid another Silicon Valley. It's going to happen again and again and again. All because the tax code is very prominent in favor of lending and not in favor of capital. Capitalism, i.e. capital. Raise capital by and basically selling your shares to companies to raise capital as opposed to leveraging, which is borrowing. All right, love your thoughts. We'll see you.